The committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. This hearing is entitled Protecting Seniors, a review of the FHA's Home Equity Conversion Mortgage Program. And at this time, I will recognize myself for 4 minutes to give an opening statement. And today's hearing will explore the racial wealth gap in the context of reverse mortgages, and in particular, the program insured by the government called the Home Equity Conversion Mortgage, or HECM program, which officially came on the books in 1988. I intend to aggressively continue to point out problems that exist in the broad world of housing, such as a lack of affordable housing, the assault on the disparate impact rule by the Trump administration, and the decreasing value of homes in Black communities like mine in St. Louis, many of which stem from unsound policy and business practices that we may be able to turn or forge ahead with viable solutions on. HECMs can help make a difference in the lives of seniors, providing personal and financial stability, a flow of income, and most importantly, peace of mind. Unfortunately, in many communities nationwide, a significant number of reverse mortgage loans are now in foreclosure, putting elderly homeowners at risk of eviction and homelessness. Some of the testimony today will provide an overview of the problems facing reverse mortgage borrowers while focusing on improvements that could be made to reduce the number of vulnerable seniors at risk of losing their homes. And a recent USA Today news article shed light on some of the problems that persist with foreclosures of reverse mortgages. Despite attempts by Congress and HUD to improve the program, according to the article, nearly 100,000 reverse mortgages have failed, with urban African American neighborhoods feeling a disproportionate impact. Specifically, the USA Today's investigation found that reverse mortgages end in foreclosure 6 times more often in predominantly Black neighborhoods than in neighborhoods that are 80% white. And even with counseling, seniors in St. Louis and across the nation have found themselves burdened with mountains of paperwork as they try to quiet title after a spouse has passed, dealing with complicated disclosures, and in some of the worst cases, trying to stop foreclosures. And from these problems with HECM, the racial wealth gap is exacerbated, as countless families in the Black and Latino communities are deprived of the chance to pass on their homes and other property to their children and other heirs, leading to increased gentrification, gutted city blocks, and less overall wealth. As such, I look forward to hearing from the witnesses today on ways to continue to improve HECM and help protect our most precious asset, seniors. At this time, I will yield to the 30 seconds to my friend, my colleague from Ohio, Ms. Beatty.
Thank you, Mr. Chairman. It is indeed my honor today to recognize with me today Mr. Willis Brown, who is an area commissioner in my congressional district. He hails from New York to Ohio. It's special for him to be here today because he is an agriculturalist specialist, domestic and international, with a specialty, Mr. Chairman, in housing and protecting our seniors. And I yield back.
I thank the gentlewoman for that introduction and welcome to the committee. And at this time, I will yield 5 minutes to Mr. Gooden, the new ranking member or acting.
Thank you, Chairman Clay. I appreciate that. And on behalf of the Republicans on the committee, I'd like to wish the Democratic Member Services Director Clement a happy birthday.
Okay. Yeah.
Again, thank you, Mr. Chairman Clay, and thank you to our witnesses for being here today. Before we hear from them, I'd like to take a moment to acknowledge the importance of reverse mortgages in general, and specifically HUD's Home Equity Conversion Mortgage Program for our aging population. The HECM program was created to allow seniors to access their real estate equity while making it possible to stay in their homes. Even today, its primary goal is guided by the good intention of allowing seniors to age in place and protecting a post-retirement lifestyle without the need of selling their home. While the HECM program is a good way to provide this opportunity to our elderly, I believe there's still some more room for improvement. Recently, several concerns have been raised about the program. Concerns about HUD servicing procedures, problematic foreclosures, and the issue of non-borrowing spouses all lead me to believe that this program needs some measure of reform. Simply put, we need to figure out a solution to these problems, working closely with HUD, and if necessary, working out a greater reform plan, whether it be through legislation at this committee or otherwise. On that note, I'd like to acknowledge Chairman Clay's bill to tie the HECM maximum loan limit to the area maximum loan limits for FHA's forward mortgages. This is an interesting idea, and we should always welcome ideas that could make a product better. In short, I look forward to hearing from our witnesses today about their thoughts on this program, and thank you again for being here with us. I yield back.
Today, we welcome the testimony of Sarah Bowling Mancini, staff attorney for the National Consumer Law Center. Also, Alicia Puente Cackley, Director of Financial Markets and Community Investment, the Government Accountability Office. Mr. Peter H. Bell, President and Chief Executive Officer of National Reverse Mortgage Lenders Association, as well as Laurie Goodman, Vice President of Housing Financial Policy at the Urban Institute. And welcome to all of you. And let me remind the witnesses that your oral testimony will be limited to 5 minutes. Without objection, your written statement will be made part of the record, and you are now recognized for 5 minutes to give an oral presentation of your testimony. You may proceed, Ms. Mancini.
Chairman Clay, Ranking Member Gooden, and members of the committee, thank you for the opportunity to testify today. I'm an attorney with the National Consumer Law Center, where I provide training and technical assistance to advocates around the country helping homeowners in reverse mortgage foreclosure. I also work for Atlanta Legal Aid, where I represent struggling homeowners. And I testify here today on behalf of the National Consumer Law Center's low-income clients. Charlotte Lowe was struggling. After working a lifetime, she was now living off of Social Security benefits and a little extra money from babysitting. She and her husband had bought their home in the 1960s. In 2003, at 68 years old, she was faced with the need to make significant modifications and repairs to her home. She had no other savings, but the mortgage on her home of 38 years was paid off. Congress authorized HUD to create the HECM program to help seniors like Ms. Lowe tap into their home equity without the risk of displacement. Borrowers age 62 and up can obtain the loan proceeds either as a lump sum, a line of credit, or a stream of monthly payments, and are not required to pay back principal or interest on the loan while they live in the home. The balance grows over time, and the loan is paid off when the borrower dies or moves out. Without this option, many seniors would have to either sell their home, leading to higher housing costs, or take out a regular mortgage, which is often not affordable and can lead to foreclosure. The HECM program makes a huge difference in the lives of older adults, allowing them to remain stable in their homes. Unfortunately, a significant number of reverse mortgage loans are now in foreclosure, putting older borrowers at risk of eviction and homelessness. We want to thank Chairwoman Waters for her leadership on these issues and for the discussion draft of her bill, the Preventing Foreclosures of Seniors Act of 2019, which would provide significant relief for older homeowners. On Monday, HUD announced a new policy on reverse mortgage non-borrowing spouses. HUD has now removed the problematic deadlines for the mortgagee optional election, or MOE, which allows the spouse to remain in the home. This change will help many struggling widows and widowers, and we want to thank HUD for addressing those problems. I want to focus on a significant unresolved problem, property charge defaults. According to HUD data, as of 2016, roughly 90,000 reverse mortgages were in default on property charges. Out of 600,000 active HECM loans, having close to 100,000 in default is staggering. Why are so many HECMs in default on property charges? A significant factor is the aggressive marketing of reverse mortgages by silver-haired celebrities, often misrepresenting that this is a payment-free and risk-free loan. In my written testimony, I described the enforcement actions as recent as 2016 for this very kind of false advertising. Many HECM borrowers did not understand that they were obligated to pay the property taxes and homeowners insurance. If they had had a forward mortgage in the past, those charges had been escrowed as part of their monthly payments. For years, HUD did not require lenders to foreclose when borrowers defaulted on property charges. Borrowers sunk deeper into default without even knowing it. And in 2015, HUD abruptly changed its policy and began requiring lenders to foreclose quickly on these borrowers. HUD tells lenders that they can offer the borrower a home retention option, like a repayment plan, but any such review is optional. And if the lender doesn't foreclose within the required timeframes, HUD imposes a financial penalty known as interest curtailment. The lender's incentive is to foreclose quickly and not bother with loss mitigation. HUD should address these problems by, number one, making loss mitigation mandatory for new HECM loans, number two, expanding the available loss mitigation options, and three, providing servicers with a clear extension of foreclosure deadlines to evaluate loss mitigation. Chairwoman Waters' draft bill would require all of these changes. The impact of reverse mortgage foreclosure crisis is being felt primarily and disproportionately in communities of color, where the rates of reverse mortgage foreclosure are 6 times higher than the rates in majority white neighborhoods. Many HECM borrowers are losing homes that have been in their family for generations. And of course, every foreclosure impacts home values in the whole community. The best way to address this problem for these communities and all reverse mortgage borrowers at risk is to require effective loss mitigation and servicing of HECM loans. Thank you, and I'll be happy to take questions from the committee.
Thank you for your testimony. Ms. Cackley, you are recognized for 5 minutes.
Chairman Clay, Ranking Member Gooden, and members of the subcommittee, I'm pleased to be here today to discuss oversight of reverse mortgages made under the Home Equity Conversion Mortgage Program administered by the Federal Housing Administration. Reverse mortgages, or HECMs, are loans that allow seniors to convert part of their home equity into payments from a lender while still living in their homes. While reverse mortgages can help senior homeowners meet financial needs, they also can present risks to borrowers and their spouses. My testimony summarizes findings from our report on the HECM program, which is being released today. I will address 3 main topics. First, our analysis of FHA data on HECM loan outcomes, including terminations and the use of foreclosure prevention options, as well as the extent to which FHA monitors these indicators. Second, FHA's oversight of companies that service HECMs. And third, FHA's collection and use of consumer complaint data for oversight of the HECM program. According to our analysis, in recent years, a growing percentage of HECMs have ended because borrowers defaulted on their loans. Terminations due to borrower defaults increased from 2% in fiscal year 2014 to 18% in fiscal year 2018. Most HECM defaults were due to borrowers not meeting occupancy requirements or failing to pay property charges, such as property taxes or homeowners insurance. Since 2015, FHA has allowed HECM servicers to put borrowers who are behind on property charges into repayment plans to help prevent foreclosures. However, as of fiscal year end 2018, only about 22% of these borrowers had received this option. We found that FHA's monitoring, performance assessment, and reporting for the HECM program all have weaknesses. For example, FHA loan data do not currently capture the reason for about 30% of HECM loan terminations. FHA also has not established comprehensive performance indicators for the HECM portfolio, and has not regularly tracked key performance metrics. That is, metrics such as the percentage of HECM terminations due to borrower defaults, the proportion of active HECMs with delinquent property charges, or the percentage of distressed borrowers who have received foreclosure prevention options. In our report being released today, we recommend that FHA take steps to improve the quality and accuracy of HECM termination data, and that it establish, periodically review, and report on performance indicators for the HECM program, and examine the impact of foreclosure prevention options in future program evaluations. Additionally, FHA has not developed internal reports to comprehensively monitor patterns and trends in loan outcomes. As a result, FHA does not know how well the HECM program is serving its purpose of helping meet the financial needs of elderly homeowners. We recommend that FHA develop analytic tools such as dashboards or watch lists to better monitor outcomes for the HECM portfolio. These tools could help FHA more easily track and monitor useful metrics such as termination reasons, defaults, use of foreclosure prevention options, or advances paid by servicers on behalf of HECM borrowers for unpaid property charges. With respect to FHA's oversight of HECM servicers, we found that oversight has been limited in recent years. FHA has not performed comprehensive on-site reviews of HECM servicers' compliance with program requirements since fiscal year 2013. We recommend that FHA develop and implement procedures for conducting on-site reviews of HECM servicers, including a risk rating system for prioritizing and determining the frequency of reviews. With respect to FHA's collection and use of complaint data, FHA collects and records inquiries and complaints about HECMs, and it has access to the Consumer Financial Protection Bureau's data on reverse mortgage complaints. However, FHA does not use its inquiry and complaint data to help inform HECM program policies and oversight, and the way data are collected does not produce quality information for these purposes. We also found that FHA has not leveraged CFPB complaint data for HECM program oversight. We recommend that FHA collect and record consumer inquiries and complaints in a manner that facilitates analysis of the type and frequency of issues raised. We also recommend that FHA periodically analyze available internal and external consumer complaint data about reverse mortgages to help inform management and oversight of the HECM program. These actions could improve FHA's ability to detect and respond to emerging consumer protection issues regarding HECMs. Chairman Clay, Ranking Member Gooden, and members of the subcommittee, this completes my statement. I would be pleased to respond to any questions you may have at this time.
Thank you very much for your testimony. Mr. Bell, you're recognized for 5 minutes.
Chairman Clay, Ranking Member Gooden, and members of the committee, thank you for convening this hearing. Several issues regarding reverse mortgages have been discussed by this committee in the past, and has always resulted in steps being taken to strengthen the program. By and large, the HECM program has been largely successful, helping over 1 million households deploy their housing wealth to live a more comfortable retirement. We should not lose sight of that fact. Nevertheless, whenever a new program concept is implemented, there is always a learning curve and room for improvement. The Congress and several administrations have taken steps over the years to improve the FHA reverse mortgage program. These include enhancing counseling to include financial assessment and benefits checkup, requiring set-asides for taxes and insurance, reducing principal limit factors, creating higher mortgage insurance premiums, limiting the amount of equity that can be withdrawn in the first year of a HECM, implementing loss mitigation tools for borrowers in default, and creating protections for non-borrowing spouses. Each time the program has emerged stronger, consumers have been given better safeguards, and the FHA fund has been further protected. I'm sure that will be the outcome of the discussion today. In fact, earlier this week, HUD issued a mortgagee letter improvising revised procedures for non-borrowing spouses, which I believe will address several of the concerns voiced here today. The Waters HEC draft bill would make similar changes to HUD's initiative and goes a little further. One important change would extend the so-called non-borrowing spouse provisions to cases where the borrower is not yet deceased but has left the home permanently and is living in a care facility. The HECM is a highly misunderstood financial instrument. There is a lot of angst about it. There is also a widespread notion that lenders are looking to take advantage of borrowers. This is misguided. Lenders are in the business of making loans, not owning real estate. No lender ever wants to foreclose if it can be avoided. Foreclosure, however, is often the routine manner of terminating a reverse mortgage. When a borrower passes away and the loan balance exceeds the value of the home, there is little incentive for the heirs to take any action. In other cases, there is no next of kin available to step in and handle a property disposition. Lenders must act within HUD-specified timeframes, inhibiting their ability to work with borrowers in default. HUD's mortgagee letter issued this week now provides some greater flexibility. To prepare for this hearing, we collected data from two services with significant HECM portfolios. The first servicer looked at a portfolio of 329,000 loans. Of these, 18% went to foreclosure. However, over 75% of those were due to death of the borrower or non-occupancy. Only 5% of the loans in this portfolio ended up in foreclosure due to a tax and insurance default while someone was living in the home. The second servicer reported on 179,000 loans, found that 22% went to foreclosure, but over half of those, 50.3%, were due to death and another 15.3% to non-occupancy. Only 7.5% of the foreclosures in this portfolio were due to tax and insurance default with an occupant in the home. I do not believe that these percentages differ and might actually be lower than experienced with mortgages overall. HECMs get blamed for a lot of things. Foreclosure due to non-payment of taxes is one example. But is this really a HECM issue? If someone with a forward mortgage, or even someone who owns their home free and clear, fails to pay taxes, what happens? They face a tax foreclosure. In fact, with a HECM, the servicer advances funds on the borrower's behalf and then works out a repayment plan that could be spread out over several years. This is a safeguard for HECM borrowers that is not generally available to other homeowners. A fair assessment of reverse mortgages would look not only at the end results, but also the circumstances faced at the time of loan origination. In many cases, borrowers have been overburdened with mortgage payments that they cannot meet on their current income. The HECM enabled them to get rid of these monthly payments, providing opportunity to focus on other expenses and reorganize their finances. The elimination of a monthly payment, coupled with information that borrowers gain from benefits checkup and other topics discussed during the mandatory counseling session, are often enough to get homeowners back on track and preserve their ability to remain in their homes. In fact, the large majority of HECM borrowers remain in their homes until they pass away. In closing, I would like to reiterate that the HECM program has been largely successful over the years in helping most borrowers sustain themselves in their homes for the balance of their lives. We should not lose sight of this, and we should work together to figure out how to make the program better and safer and more responsive to the needs of today. In my written statement, I addressed all of the 7 questions asked in the subcommittee's invitation. I am prepared to address any of those or any other questions during the balance of the hearing. Thank you again for the opportunity to participate today, and thank you for the sincere interest in this topic expressed by members of the committee. It's always a pleasure to work with you and your staffs.
Thank you, Mr. Bell. Ms. Goodman, you are recognized for 5 minutes.
Thank you. Chairman Clay, Ranking Member Gooden, and members of the subcommittee, thank you for the opportunity to testify today. My name is Lori Goodman, and I am the Vice President for Housing Finance Policy at the nonprofit Urban Institute. I spent close to 30 years as a Wall Street mortgage-backed securities analyst and left to found the Housing Finance Policy Center about 6 years ago. The views I express are my own and should not be attributed to the Urban Institute, its trustees, or its funders. My comments today will focus on why FHA's HECM program is so valuable and offer suggestions for how the program can be improved. Many retired and soon-to-be retired Americans lack the financial assets for a comfortable retirement. Enter the American home, the most commonly held and valuable asset for most American families. Seniors are more likely to be homeowners and are more apt to have more home equity than younger Americans. Seniors have a home ownership rate of close to 80% versus 64% for all households. In 2016, they had median home equity of $143,400, 43% more home equity than homeowners of all ages. Home equity plays an even larger role in the net worth of Black and Hispanic seniors, constituting 64 and 70% of the median net worth for these households, compared to just 40% for whites. There are 5 main vehicles for extracting home equity. In order of popularity, they are HELOCs, cash-out refinancing, selling your home, second mortgages, and reverse mortgages are in 5th place. These programs are not being used extensively, and reverse mortgages are being used the least. But HECMs are the only form of home equity extraction available to many lower income and credit-constrained homeowners. Reverse mortgage borrowers have the lowest income and the lowest credit scores of all equity extraction products. This is because lower income borrowers have trouble qualifying for forward mortgage products that require monthly payments. In addition, until 2015, the HECM program had no real credit underwriting, and now the financial assessment is used only to evaluate if the senior can pay taxes and insurance. If not, there is a tax and insurance set aside. The importance of tapping into home equity will grow as the senior population surges in the next decade from 22% of the population in 2016 to 30% by 2030. Moreover, younger seniors are more apt to enter retirement with a mortgage than older seniors, making reverse mortgages an even more valuable product. So how do we increase the use of and fix the concerns about reverse mortgages? We need to focus on three things. First, we need to improve financial literacy about reverse mortgages overall. This will cut the scope for scammers. This could include incorporating information about tapping into home equity in the financial planner certification process with accompanying rules about what financial planners can say and how they can be compensated. Right now, they can't. As a short-term fix, the Social Security Administration could provide education and outreach to seniors about reverse mortgages. We should also get borrowers into reverse mortgage counseling earlier in the process and provide more targeted counseling. It would be beneficial for reverse mortgage servicers to check in with the borrower right after closing, ensuring they understand the program's benefits and obligations and how to contact the servicer. Second, we need to simplify reverse mortgage product design, lower costs, and encourage innovation. This should include eliminating infrequently used options that just muddy up the world of reverse mortgages, as well as streamlining the process of converting a forward mortgage into a reverse product. HUD should also reintroduce a modified version of its HECM Saver program. We should also encourage the development of proprietary non-HUD alternatives, which is a small but growing market, by reducing loan limits for the HECM program. $726,525 nationwide is just too high. Finally, we need to redesign existing programs to reduce foreclosure frequency and loss severity. Foreclosures can be significantly reduced by making the escrow of tax and insurance funds the default for reverse mortgages. We can also require that servicers provide regular reminders to borrowers about their tax and insurance obligations. Loss severity can be reduced through improvements in the Cash for Keys program and by allowing existing servicers to continue their role after assignment. The HECM program is a valuable vehicle to tap into home equity and is the sole option for many low-income senior households. It will become even more valuable and more necessary as the senior population grows and the proportion of those seniors with a mortgage and limited retirement savings also increases. Helping more seniors age comfortably in their home is an issue that should generate bipartisan support, as the alternative for many would be a nursing home or another facility paid for with taxpayer dollars. There are ways to improve this valuable product to both better meet the needs of senior borrowers and to be more cost-effective. I urge the committee to focus on these areas for improvement and to help ensure that this valuable program can realize its full potential. Thank you.
Thank you, Ms. Goodman, and thank you to the entire panel for your testimony. Now, I recognize.
Thank you, Mr. Chairman. I ask unanimous consent to insert the ranking member's full committee's statement for the record.
Without objection. Let me start the Q&A now. I'll recognize myself for 5 minutes. And let me start with Ms. Mancini. The National Consumer Law Center has done some groundbreaking work in the area of reverse mortgages and HECMs, and your testimony today speaks to that. Can you talk about some of the problems with pre-loan counseling and how we can work to fix them?
Thank you, Mr. Chairman. The pre-loan counseling is a very important piece of the puzzle for safeguarding consumers as they enter into this very complex financial product. Unfortunately, there's not enough funding for HECM pre-loan counseling, and oftentimes the counseling has to be done over the phone and in a very short format. Sometimes it's no longer than 30 or 45 minutes, which is really not enough time to cover all of the issues that have to be covered in that pre-loan counseling. And so the pre-loan counseling, while it's very important, could be more effective if there was better funding for housing counselors to be able to devote more time and go into more detail.
I see. And are there any current practices or stipulations now that are in the contracts that should just be outright outlawed? Are there any things that raise your antennas?
Well, Mr. Chairman, the issues with respect to non-borrowing spouses had been a major concern for many years, and unfortunately, we're not sure why HUD delayed so much in actually fixing that problem. It took 2 lawsuits to get HUD to create a program to help borrowers, non-borrowing spouses that were stuck in this situation. And then even after 2015, there were these deadlines that were blocking access to help for these widows and widowers. But now, with the new policy that was announced on Monday, we think that non-borrowing spouses are in a much better situation. And the only 2 issues that we see that remain to be addressed for non-borrowing spouses are to extend the foreclosure deferral to situations where the borrower has moved out of the home for health reasons but has not yet passed away. And the second issue is for loans that were originated after 2014, HUD should make the same change that it made for pre-2014 loans to eliminate the requirement to show good and marketable title or legal right to remain. With those additional fixes, we would be in very good shape.
Thank you for your response. And let me ask Ms. Goodman or Mr. Bell, do you agree with Ms. Mancini's recommendations about how we protect the surviving spouse?
Yes, I think that it's would be a very good idea to extend the non-borrowing spouse provisions that exist when the borrowing spouse passes away in cases where the actual borrower is permanently out of the home in a care facility. And I believe that the draft bill, the Waters HEC bill, addresses that.
I see. Ms. Goodman?
I agree as well.
Thank you. Let me ask Ms. Cackley. There was a USA Today article that talked about how HECM loans were targeted for minority borrowers in a way that led to disproportionate rates of foreclosures in minority communities. Based on GAO's investigation, is HUD appropriately monitoring these fair housing concerns? And specifically, does HUD collect sufficient data to determine if foreclosures are disproportionately affecting
Mr. Chairman, I think that that is correct, that HUD doesn't really have the data that it needs to, or isn't looking at the data that it has in a way that would allow them to make those kinds of determinations. We did not look specifically at the issue of differences across minority populations. We did look a little bit at just differences in default rates across states, and that information is in our report. But the lack of quality data that HUD has looked at and made use of is it's not enough for them to be able.
And have you all made recommendations to HUD?
We have certainly made recommendations to HUD that they improve the quality of their data.
I see. Thank you. Mr. Bell, your industry has worked to improve the image of reverse mortgage lenders, which has over the years been accused of taking advantage of unsuspecting seniors. While unfortunate, I think you would be the first to agree that some of this has been self-inflicted. Can you quickly tell us what some of the reforms are that you all have taken up?
Well, there's been a lot of reforms over the years. Strengthening counseling, I think, is an important one. Adding the financial assessment component to counseling is very important. We tried to do that on a voluntary basis initially within the industry, but we don't represent 100% of the industry. So instead, we looked to HUD to implement it, which they ultimately did. And that has made a big difference. You see that the books of business post-financial assessment perform much better, because part of the financial assessment is looking at the likelihood of success for that borrower. Do they have enough income to sustain themselves in the home? And if they don't, then we require a set-aside of some of the available loan proceeds to be lopped off from what's available to them and held aside to be able to pay taxes and insurance. So that's a very significant one. Certainly, the non-borrowing spouse provisions have been helpful, and as of earlier this week, as has been said, they're going to be more helpful. There has been some reduction in some of the ongoing mortgage insurance premium, and that's been helpful as well.
Thank you for your response. And let me go to the distinguished gentleman from Texas, Mr. Gooden. You're recognized for 5 minutes.
Thank you, Chairman Clay. Ms. Goodman, you mentioned in your research that loans assigned by the FHA to HUD have a loss rate of roughly 42% compared to 12% when they remain with the original servicer. And some of those reasons you mentioned in your research were that FHA policies don't maximize the value of properties, and servicers' incentives in combination with their specialized knowledge reduce losses apart from the confusion caused to the borrowers. Part of your solution was to allow the original servicers to continue servicing the loans, and I was hoping you could expand upon that and also note what you would require to make those changes.
So I would actually suggest that you allow the original to assign the loan to HUD as you currently do, but basically HUD pays the current servicer on a fee-for-service or another negotiated basis to just continue to service the loan. I think actually some of Peter's numbers were very, very interesting. HUD has a policy of not foreclosing, but a huge percentage of those homes that it doesn't foreclose on are actually people who have died or moved out of the home. And so what that does, so basically the home is just sitting there deteriorating. So HUD clearly doesn't maximize. The current servicers do a much, much better job, and just let them continue to service the loan and pay them on a fee, on a negotiated basis.
Thank you. And in your 3 points to improve the program, the last one, your third point, was to redesign programs to reduce foreclosure frequency and loss severity. And in that, you talked about the paying the taxes and the insurance. Could you expand upon that?
Yeah, and this actually goes to the heart of some of the issues that my colleagues mentioned as well. So right now, you have tax and insurance. So actually, FHA actually made a big step forward when they did the financial assessment, where if you don't qualify, you actually have to do a tax and insurance set aside. Why not just make that default? Why not just make that the default? Why not say no financial assessment is required if you're going to agree to the tax and insurance set aside? If you want to go through a financial assessment, then we can waive it. So just change what the default is. So I thought that that's one very valuable option. A second very valuable option would be there's a study by Stephanie Moulton and some colleagues at Ohio State University that basically showed that you can cut defaults by as much as 50% if the servicers simply sent out reminders to the borrowers, hey, remember to pay your tax and insurance payments. In terms of cutting loss severity, we just talked about the allowing this original servicer to continue to service, and then also improving the Cash for Keys program could make a big difference.
And Mr. Bell, thank you, by the way. Mr. Bell, I may have misheard you, but you were kind of talking about how everyone is in the same boat. Everyone has to pay your taxes and insurance, whether you're in this program or not. Do you all support those changes that she listed?
Yes. I mean, this is the first I've heard of the idea of doing away with the financial assessment if people agree to the set-aside. I'd have to think that one through a little bit more. I think the financial assessment is a useful exercise for a prospective borrower to go through, because it forces them to sit down and look ahead and think about what resources they have and what might happen in future years. So I'm not sure that I'm ready to commit yet to that, but I think it's definitely worthy of thinking through.
Thank you. I appreciate it, and I yield back.
I thank the gentleman, and I recognize the gentlewoman from Ohio, Mrs. Beatty, who is also the chair for the Subcommittee on Diversity and Inclusion. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. I take great pride in being a housing expert, spending more than 20 years working in public housing, Section 8, and trying to locate affordable housing for families and seniors. So I have two questions I'm going to try to get through briefly to allow each of you to have an answer. The first question is on foreclosures due to property taxes. Last month, I held an affordable housing hearing in my district with some 400 people who attended, many elected officials, many people like the area commissioner, Mr. Brown. Our county treasurer stood up and said that 30% of the seniors who were losing their homes were not because they didn't pay their mortgages. They had done everything right for the American dream, but the problem became of the escalating property taxes on those homes that they were losing the homes because they were being priced out of their neighborhoods. So when I hear of people losing their homes for not paying their taxes off, the question comes, and maybe I'll ask you, Ms. Cackley, start with you. Based on your investigation, is there any way to know the amount of money that was owed that resulted in the HECM termination in case of a borrower's default?
Yes, it's possible to, in the data that FHA has in their system. We did some looking at the number of defaults that were due to a less than $2,000 deficit of taxes owed. That so it is possible to look at the data and find, especially those people whose amount of default is low enough that they could take advantage of some of the programs that HUD does have.
So based on that, I'm sorry, but for the sake of my time, why are so few borrowers receiving the option to be put on a payment plan prior to the default?
I think because HUD doesn't look at the data enough to know and identify those
So what is the resolve that we should have for these seniors? That's part of our hearing today, to have experts. What do I go back home and say to those individuals?
I think part of the one thing you can say is let them know that these repayment programs and extension low-cost extension programs exist, so that they can ask for it. But I think we also have to make sure that the HUD program does what they need to do to find those people and offer it.
Thank you. In FHA, second question, in FHA's most recent report to Congress on the financial status of the Mutual Mortgage Insurance Fund, or as we call MMIF, they reported that the MMIF had a capital ratio of 2.76, well above the mandate of 2.0. The capital ratio for the forward mortgage portfolio, which is overwhelmingly used by first-time home buyers and minorities, African Americans in my district, households, they just want to achieve the American dream, was 3.93%, while the capital ratio for the reverse mortgage portfolio was negative 18.3. 18.3. I want the American people to hear that. So back in January of 2017, I wrote to Secretary Carson, urging him to follow through on the previous administration's decision to lower the mortgage insurance premiums for FHA loans, which would lower the cost of the mortgage insurance for FHA borrowers. This could have saved people hundreds and hundreds of dollars a year. So as we know, Secretary Carson overturned the Obama administration's decision, citing the financial status of the MMIF. So question, are borrowers who receive a 30-year mortgage from FHA effectively subsidizing the FHA's reverse mortgage program? And Ms. Goodwin will ask you to answer that. And then Mr. Bell, you're on track. So you have 10 seconds because I have to get to Mr. Bell.
So basically, I think
Yes
that
or no? Are they or not? In your
I
opinion?
think that HECM should be moved out of the MMIF, and leaving them in does a disservice to both programs. As you point out, they're very, very different, and each program should be evaluated on
So
its
we
own
should
merits.
separate the funds.
We should separate the funds.
Yes or no, Mr. Bell, and should we separate the funds?
It's not simple enough for a yes or no.
Should we separate the
Historically,
funds?
yes.
My time.
Yes.
Should we separate the
Yes.
funds, yes or no? Okay. I'm sorry, my time is up. Maybe somebody will yield me sometime.
I thank the gentlewoman for her line of questioning. At this time, I recognize the gentleman from Colorado, Mr. Tipton, for 5 minutes.
Thank you, Mr. Chairman. Appreciate y'all taking the time to be able to be here. When we're talking about statistics, we do often talk in urban areas. I'm a little interested, Mr. Bell, maybe you could answer this. How many of the HECM loans are made in rural America where we have an older, poorer population?
I don't know that offhand.
Okay. Can you maybe educate me a little bit on this? What type of a loan to value is made on a HECM? Let's say I paid my house completely off. It's worth $100,000. What type of a loan to value would be made on something like that?
Okay, I'll try to explain this in the time that you have available. But essentially, the concept of a HECM is that you get an amount of money that's based on your age, the value of the home, of course, and the interest rate. It's a percentage of the value based on your age. A younger borrower gets a lower percentage of value than an older borrower. The reason being because it's presumed that the younger borrower will occupy the home longer, so therefore more of the value needs to be reserved for the interest that will accrue. That being said, the amount available probably ranges from the high 40% for a youngest borrower at 62 years old to probably approaching the high 60% for a borrower in their 80s.
All right, I appreciate some explanation on that. And Mr. Chairman, just to let you know, I do read some of your slides that you put up and noted that 9% of these are repaid totally that are going in. So for loans that do not end in a default, how many transactions, if someone can answer this, does FHA end up paying an insurance claim on to the originating lender? Does anyone know? That when we're talking about maybe some statistics might be something that we might want to be able to have as well when we're looking at it. And I'm a little curious, Ms. Goodwin, maybe Mr. Bell, you might be able to speak at this. With the HECM program, lender competition isn't very active. We saw Wells Fargo, Bank of America drop out, I think, about 10 years ago, never have returned. What can we as policymakers do to be able to spur greater innovation and consumer choice in the reverse mortgage market space?
I think the major banks dropping out of the reverse mortgage business is no different than many of the major banks dropping out of the mortgage business. Generally, the mortgage business has moved over the past several years to be much more dominated by specialty finance companies and non-bank lenders. Our side of the industry is no different than the rest of the industry in that regard. The reasons that the major banks, which were MetLife, Wells Fargo, and Bank of America, exited the business are different in each case, but they're for reasons external to their reverse mortgage activity.
Just to pick up on one additional point, in addition to what Peter said, yes, you know, they've cut back on both for forward mortgage programs with FHA and their reverse mortgage programs, but I think with the reverse mortgage programs, they perceived a great deal of reputational risk in terms of loans to senior borrowers. I think you have to realize that the HECM program is enormously complex. If I take out a forward mortgage, I have two choices. I can choose a fixed or adjustable mortgage, and I can choose a mortgage term 15 or 30 years, and that's it. In contrast, the HECM offers many more options. I can do a fixed or adjustable rate. I can do a lump sum distribution, line of credit, term annuity, 10-year annuity, or a combination of payment options. And I can determine the timing and pace at which the funds can be withdrawn. So this plethora of options makes the product more difficult for the borrower to comprehend and puts the institution making the loan at more risk. And I actually think that program simplification, getting rid of some of the less used options, would make a big difference.
Great. Any other comments from you? Okay. And I guess one other area I'm a little bit concerned on is if housing prices do dip, we're in kind of a sweet spot pretty much nationwide right now on the housing market. But if those housing prices dip, just how resilient will the fund be, and specifically how will the home equity conversion mortgage market program within the fund operate? Mr. Bell, do you have any knowledge on that?
That's the reason for the actuarial analysis that is done, because HUD has levers it can operate to make the program pencil out properly. They can reduce loan to values, we call them principal limit factors. They could raise mortgage insurance premium. So the concept of this is that they do make adjustments along the way, and certainly they have over the years to try and keep the program in check.
Yeah, I think certainly some concerns that we can have on that when we saw the housing crash before in terms of some of those tables to be able to look out the windshield to make sure that we aren't putting people in a bad position. Mr. Chairman, I thank you for the leniency on time, and I yield back.
Thank you. And I recognize the gentleman from Washington, Mr. Heck, for 5 minutes.
Thank you, Mr. Chairman. Indeed, I'd like to thank you very much for your willingness to hold this hearing on what I think is a very important issue. I'd also like to express my appreciation to Chair Waters for encouragement of us taking up this issue again. I'd like to thank, in particular, Ms. Mancini, Mr. Bell, and Ms. Goodman for all your remarks. And in particular, I cannot help but note that each of you used as a predicate the value of this program to some people being really important. The reasons for that have been alluded to. Ms. Goodman, you did a particularly good job of this. It's about retirement security. And it's about living in a world in which the number of defined benefit programs has fallen off the table. It's about living in a world in which 46% of households don't have $400 savings to even replace the tires on their car, should they need to be replaced. It's about living in a world in which the average retirement accounts $60,000, which combined with Social Security doesn't provide much of a retirement standard of living. And you all said, this is a good program. Now here's some things we need to do better. But I want to contrast that positive predicate with what we went through several years ago when I had the privilege to lead the effort to modernize HECM program, in which there was a lot of the debate around the issue of, or the question of whether or not we should even have a reverse mortgage program. We've come a long way. And we've come a long way, I think, because more broadly people recognize its value, in part due to some of the changes that we made, in part due to your willingness to advocate for it and bring forth additional changes. And Ms. Cackley, I want to thank you as well. I hope you will be pleased to know that virtually every one of the recommendations in the GAO report I will incorporate into the next draft. And we are in the process of that as we sit.
Thank you very much. I definitely am happy to hear that.
Your work was of value. Mr. Bell, I guess I want to start with you because I think it is important to remind us of the basics here. This is obviously an important financial tool for people who are asset rich but cash poor. You yourself called it a highly misunderstood instrument in your testimony, as I recall. So I want you to give more color to talking about how a HECM loan is distinct from other products like home equity or lines of credit, and focus on an example of someone for whom this particular financial product has benefits others don't, and how that might play a role in their life, if you would, please, sir.
I'm sorry, Congressman, I missed part of what you said towards the end there, but
You were just
what I think I
you were
heard.
basking in the glory of my compliments of all your.
Well, the idea of a reverse mortgage versus the other types of products like a home equity loan is that it's a loan available to people in a time of fixed limited income. And being able to either qualify for a loan that has payments is a challenge for them, or they currently have a loan with payments and the challenges are overburdening them. The idea of a reverse mortgage is that the money is patient, meaning that it waits to be repaid. The borrower can draw down on the money today, and they could make payments if they want to in order to keep the balance down and keep the interest from accruing, but they also have the option of not making any payments and just deferring those payments until they permanently leave the home. That has phenomenal impacts on different borrowers in different ways. It allows them to not be worried about missing a payment on their house and facing foreclosure there. It allows them to be able to pay their utilities, pay their taxes, pay for their health care needs. It allows them to sustain themselves in the house for a long time. And if they use a HECM with the line of credit feature, there's a growth to the line of credit over time, so it actually gives them even a greater amount of money over the long term than it would if they were to draw it all up front. So the product has tremendous flexibility, and behind every HECM, there's a story and a reason why people get it. Nobody wakes up in the morning and says, oh, I should get a HECM today, but people do lay in bed at night wondering, how am I going to make my payments? How am I going to fix the roof? Where are we going to get the money to visit the family at Christmas? And the HECM is used as a solution to all of these kinds of things.
Well said, sir. I'm out of time, unfortunately. I yield back, Mr. Chairman.
I thank my friend from Washington, and I recognize the gentleman from Wisconsin, Mr. Steele, for 5 minutes.
Thank you very much. I appreciate the chair holding today's hearing on this important issue. Reverse mortgage can be really helpful to allow seniors to live comfortably in their homes, in the communities where they've built their lives. At the same time, we have a responsibility to ensure that people who've worked hard their whole lives are not taken advantage of and misled through steps to secure their retirement. My district is roughly 113,000 seniors, 16% of the population. I think we owe it to them and to seniors across the country to conduct proper oversight of this program and implement forms to continually make it better. Dr. Goodman, among other requirements under the Federal Housing Administration guidelines for HECM loans, borrowers must demonstrate the ability to pay property taxes and insurance and participate in counseling. I'd like to focus a little bit on what's done on the front end to make sure seniors who participate in this program are able to meet all of their obligations to remain in their homes. I recognize that some of these requirements began to be implemented in 2015. Can you comment if there's been a noticeable difference in performance since that time?
Yes, there has actually been a huge difference in performance since as a result of the financial assessment. So there's been a study that basically showed that tax and insurance defaults from for mortgages that were 37 to 45 months old have declined from 6.9% before the financial assessment to 2.1%. It has made a tremendous difference and was a very positive change.
Could you provide a little color for those of us on the committee as to what this counseling looks like, how it's conducted? Is it intensive? Are there follow-up sessions? Can you just provide a little color to that?
So basically, there's a counseling session. The counseling could be improved, and I think that, that suggestion has come up. And then there's also a financial assessment where you look at the borrower's ability to pay the tax and insurance and make a determination as to whether or not there should be a set-aside. And I think the power is in that financial assessment test. And I would actually go a step further, and I would actually require no financial assessment and an automatic set-aside. That is the default. And if you want to opt out of the financial, and if you want to go through a financial assessment, then you can possibly get that feature waived.
Let me go back to the counseling for a minute. Can you just describe what that would look like, or the amount of time, or how intensive that is for individuals that go through this counseling?
I'm going to actually...
Or if somebody else has color, happy to pass.
Congressman, I'm happy to chime in on that.
Please, thank you very much.
So the counseling session, the amount of time varies. Unfortunately, sometimes there's only 30 or 45 minutes allotted, but it really requires at least an hour and a half. The counselors are supposed to walk through with the homeowner alternatives that they should consider, such as energy assistance, other programs that are available to help low-income homeowners, and then explain how a reverse mortgage works, which is pretty complicated in and of itself, the different options for how to receive the proceeds of the loan, the property charge set aside, now that that's involved. So there are many things they have to cover.
So there's an opportunity to really expand the amount of time and intensity in these counseling sessions for seniors to make sure that they're making the best decision in their own best financial interest in a reasonably complicated financial product that has real significance in their lives.
Yes, Congressman, we think that would be very helpful.
Thank you. I'd like to go back, Dr. Goodman. In your testimony, you recommended streamlining the process for converting a forward mortgage into a reverse product. Can you discuss some of the regulatory hurdles that would make that conversion unnecessarily complex?
Yeah, so there's sort of, if it's an existing FHA mortgage, it should be a little bit easier to do. If it's outside of the FHA market, you clearly need a new appraisal and all that. The advantage is that it would be a much simpler structure. It'd be a one-time draw, which investors should like. It would save on sort of marketing costs. You look at the number of younger seniors that have mortgages, and it is just so different from what used to be the case.
I appreciate that. I appreciate everyone's testimony here today, and I yield back.
I thank the gentleman from Wisconsin. At this time, the gentlewoman from California, Ms. Waters, who is also the chairwoman of the full committee, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. This is a very important hearing that you're leading here today. And I have to tell you, there have been years when I've been ambivalent about the program, knowing full well that we needed something to deal with safety and security for our seniors and their ability to stay in their homes and age in their homes, and recognizing that as a great need, and this is a possibility for achieving those goals. And at the same time, I've had many stories about problems that have arisen in the program. And it may have been discussed already. I'm sorry that I was a little late coming in, but I want to ask about foreclosures and how seniors end up with foreclosures in this HECM program. I want to basically want to know why this program that was intended to help elderly borrowers use the equity in their home stay in place. Why do we have these ongoing concerns about default and foreclosure rates that leave the borrowers vulnerable to foreclosure and housing instability? The GAO report released earlier today found that foreclosures due to borrower default increased by 16% between funding year 2014 and 2018. And I need someone, perhaps Ms. Mancini, to describe some of the reverse mortgage cases you have witnessed through your work with the NCLC and the Atlanta Legal Aid Society that will help us understand why foreclosures are increasing in a program that is intended to promote housing stability for seniors. Can you help me with that?
Thank you, Chairwoman Waters, and thank you for your leadership on these issues and for the discussion draft of your bill, the Preventing Foreclosures of Seniors Act of 2019, which would be extremely helpful. And I also want to thank Congressman Heck for his co-sponsorship of that bill. It's, as I mentioned, extremely important. What I see in my work with low-income homeowners is that, unfortunately, many of the reverse mortgage borrowers who are facing a foreclosure based on property charges are not able to get a repayment plan or other loss mitigation option because servicers say, we're not going to consider loss mitigation because we're not required to do so, and we're worried about being financially penalized if we don't foreclose fast enough. So making loss mitigation mandatory is critical. And unfortunately, many elderly homeowners are being forced into bankruptcy or worse, losing their home altogether because they can't access a repayment plan.
Well, I thank you for that explanation, and I want you to know that Mr. Heck has been working on this issue for a long time in different ways. I believe that it was one of his first bills when he came into the House working on this issue. So I am so pleased to be working with him to deal with this. There's one other thing that I'd like to say, in addition to the work that we're doing, to ensure that whether it is taxes or other kinds of fees or amounts that are needed, you know, sometimes we have this happen too often where you have seniors in this program and one dies, and usually it's the man because we live longer, women, and the mate is left who now may be entering into dementia. They don't know. They can't keep up. And sometimes they don't have the help. They don't have the assistance. We have yet, you know, to have the resources that we need to deal with, you know, our aging seniors who are entering to this part of their lives. And of course, those sums are going to back up. And I'm hoping that we can prevent that in the way that we're approaching this, but I'm still worried about whether or not we have, programs in place to be sure that we can give assistance to aging seniors who may be entering into Alzheimer's or to dementia. So it's a worry that we have.
Chairwoman Waters, I think that's a very important issue, and it relates to the servicing of these reverse mortgages. Unfortunately, currently the servicing practices are not clear enough. The letters are written in language that is so opaque and difficult to understand, even for someone who's not experiencing cognitive decline or other mental health issues. Many seniors do start to experience cognitive decline or other disabilities as they age, and so we need a servicing approach to reverse mortgages that addresses that problem, and it's very important.
Well, I don't know if our bill covers that problem. I mean, that goes beyond, I think, what we had envisioned, certainly, in what we're attempting to do. And I think we'd have to think further and try and think about, if a servicer, is able to identify that there is a problem, and we had some way to check on that rather than going into foreclosure. Maybe we need to think about that even more and see what we can do. Otherwise, like I said, there have been years when I've been, concerned about the program and wondering whether or not it was doing what it was supposed to do. And again, let me reiterate that I do recognize that it has value, and it has value that must be protected and value that must be extended so that we make sure that we're providing the kind of safety and security that our seniors need and deserve. I thank you. Thank you, Mr. Chairman, and I yield back the balance of my time. Oh, Madam Chair, thank you.
Thank you, Madam Chairwoman. The gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairwoman. One of the concerns I have is that in Congress, we tend to wait until there is a crisis to act. I worry that we aren't doing enough now, when times are relatively good, to address some structural problems with major programs because we've been lured into a false sense of security. Dr. Cackley and Dr. Goodman, should Congress and HUD, for that matter, be concerned with the general health of the FHA's Mutual Mortgage Insurance Fund if the economy wasn't as strong as it currently is? If you'd each address that.
It's always important to pay attention to the fund and to be, I think Mr. Bell had referred earlier to the fact that there are things that changes that can be made in order to be forward-thinking and pay attention to how the fund changes as the economy changes, especially as the housing market changes. So that is absolutely a part of what both Congress and HUD need to do.
I actually believe very strongly that the forward fund and the reverse fund should be separated, and that's something that Congress should be able to do. They were not together until 2009. They are two very, very different programs. The reverse program helps seniors tap into home equity. The forward program provides financing to millions, primarily first-time home buyers. The reverse program is very, very volatile. It's very difficult to estimate the value. Small changes in assumptions about interest rates or in terms of home price appreciation can make a huge difference in the value. I would actually suggest that the programs be separated and that the reverse program be a program with mandatory appropriations and not part of the MMIF.
So if housing prices dip, how resilient is the fund and this product's place within the fund? And maybe you've already spoken to that, Dr. Goodman, but And what recommendations, aside from the one that you've already made, would you make to Congress to improve the resiliency of the fund?
So I am not sure, when you look at the numbers now, they oftentimes don't make sense for this fund, so I'm not actually sure that we have the baseline right to even estimate what the effect of home price depreciation would be. So I think it's just a very difficult set of problems because I'm not sure we have the baseline right. I'm not sure we have the information. We certainly haven't tabulated the information. There are a lot of program improvements that could cut losses substantially, and we haven't implemented those. So I'm not sure I know how to answer your question.
So I'm thinking about one of the ads that one of the shows I enjoyed, the actor made shows back in the 80s, and he says, are reverse mortgages too good to be true? From the standpoint of the federal government, they may be too good to be true. Is that a fair assessment, Dr. Goodman?
I'm not sure what you mean, too good to be true.
Well, I mean, so what you're telling me is the program's not working. It's not working for taxpayers at presently. Is that?
I think we don't know how well or how poorly it's working for taxpayers, and I think it's so assumption driven, and there's a wide range of estimates and minor differences in interest rates for 30 years or home price appreciation for 30 years, or how much less home prices on homes for seniors appreciate versus the general population can make huge differences in valuation. So I'm not convinced that we have a handle completely on the base case. That said, there are a lot of program improvements that we've talked about that can cut losses substantially, and I think you're supposed to look at those.
Another issue
It's a great program, and it should be improved.
Another issue with HECMs that concerns me is that I'm not sure borrowers fully understand what they've signed up for when they take on a reverse mortgage, and I think we've already heard you speak to that. Dr. Goodman, this past May you published a blog post in which you said that when servicers keep the loans that cannot be assigned, the losses are much lower than those incurred on assigned loans. Why is that?
Because, in large part, it's because HUD doesn't foreclose, and in a large percentage of the cases, very large percentage of the cases, it doesn't foreclose. The borrower is gone or moved from the property, so the property is just sitting there deteriorating.
Thank you. I yield back.
The gentleman from Florida, Mr. Lawson, is recognized for 5 minutes.
Thank you, Madam Chair. It's a privilege to see you sitting in the chair. Welcome to the committee, and I really glad that I can have you all to educate me because y'all are really knowledgeable of this. And I asked this question based on several things. One, which value do they use to give loans for these houses? Is this the assessed value or the market value?
Congressman Lawson, the value is based on an appraisal that has to be done at the time the loan is made.
Okay, because the assessed value, most of the time, this is a lot that the homeowner wants so they can pay a low tax thing, but the houses in the area might be at a higher value. When they're doing the appraisal, do they look at what the houses are valued in the area, or do they go specifically back and say this is what the assessed value been for the last couple of years?
It is supposed to be a fair market value based on comparable sales in the area, so it's not related to the tax assessed value.
Okay. Since there's a high degree of foreclosures in the community of color, I received a call some time ago where, and I don't know whether I can explain it appropriately to you, but time had run out in terms of the amount of funding that the person had because the person lived, I guess, longer than the mortality tables stated that they were going to live. And they were worried about, the family was worried about them being put out of the residence because of there were no more resources coming in. How is that really handled? Does it make sense what I'm saying?
I think I understand, Congressman. When a person exhausts what's available in the line of credit of the loan proceeds, they can still continue to remain in the home. As long as the borrower is living in the home, there may be an issue if it's a non-borrowing spouse, but I think that's been addressed. But they can still remain in the home as long as they pay the property charges. They should not have to leave, if I understand the question.
Yeah, anyone else want to comment on that? Because
I think the only concern would be if the person really has run out of resources, then paying those property charges, it could be a problem. And I think that's actually part of the issue with the defaults that you see is that people on a fixed income may not be able to continue to pay property charges even as they age.
Okay, the other question would be, who takes advantage of the interest deduction through the IRS? Ms. Bell?
Their interest deduction, well, let me back up. An individual taxpayer is a cash basis for purposes of taxes. So when the interest is actually paid is when you could take that interest deduction. If a reverse mortgage borrower chooses to make payments on a current basis, if they decide at the end of each year, I'm going to pay down the interest that has accrued on the loan this year, then the taxpayer would be able to take that interest deduction at that time. If they defer the payment and say, I'm just going to draw down, the interest will accrue, I'm not going to pay it back until I leave the house, then that interest deduction would be available at the time that it is paid. So for instance, if a taxpayer has a lot of interest accrued over time because they live in the house with a reverse mortgage, then they sell it at move. The year that they sell it at move, they would be able to take that deduction. If they pass away, that interest deduction would be an estate issue. And I'm not that familiar with the estate handling of the individual mortgage interest deduction.
Okay, and I'm going to try to get in one other question to Ms. Goodman. Ms. Goodman, there's a lot of commercials on television about reverse mortgages. And earlier, y'all talked about all of the companies like Metropolitan, all these companies that pull out of the market. Could you tell me again why they pull out of the market?
Why the banks pulled out of the market?
Right, why they pull out?
Yes. MetLife Bank, MetLife is an insurance company. It acquired a bank and operated a bank for a while. And it's a global insurance company. And they found that they were becoming subject to Federal Reserve requirements that would have had them make disclosures in a different time schedule than they would as a company that wasn't a bank because of Federal Reserve requirements. So they basically spun off their bank and exited mortgages, banking in the U.S. entirely, and the reverse mortgage division went with that. Bank of America made a strategic decision at one point to shed a number of lines of business that were not their major areas of business, and they shed the reverse mortgage business along with that. They're still engaged on the secondary marketing side, on the securitization side. They are just not originating reverse mortgages.
Okay, my time, and I don't want the chairman to run me out of here. My time is expired. I yield back.
I would never do that to you. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Madam Chair. By the time you get to me, a lot of the questions have already been asked, so I've got some questions that sort of fill in the blanks for me with regards to issues that you brought up, but I'd like some more information on it, so bear with me for a moment. With regards to the losses that are sustained by the federal program here, the numbers I see are that the maximum claim amount is $111 billion, and the losses last year totaled about $5.6 billion, which is roughly 5.1%. Is that roughly what the program lost last year? Any of you know? Nobody knows. Oh my gosh. Okay. Okay, quick question for you here. With regards to when somebody takes out a loan, I assume that we do appraisal on it. What is the maximum loan to value that somebody can get on a loan? In other words, I assume that you can't loan 100% or borrow 100% on a loan.
Well, I explained this earlier.
I was here. I didn't hear the explanation.
But in any case, you get a percentage of the value based on your age, and the concept is that you're extended a percentage of value with the balance being reserved to cover the future interest accrual.
Right.
So if you're younger, you would get a lower amount because presumably you would occupy the home longer, so interest would accrue over a longer.
I got that part. Is there, knowing that you appraised it that way, is there a built-in fudge factor though? Just like any other home loan that you would get so that you would have a 5%, 10%, or 20% down. Now what you're trying to do is go to this, my question is there, when you figure out the amount that somebody could borrow up to, is there a fudge factor in there that doesn't include your interest and other things that go up to this factor? So if you play the market, in other words, if the market goes down or the home deteriorates because nobody's living in it, you've got some space there.
FHA, first of all, lenders do not determine how much money they make available to any borrower. FHA does. FHA publishes a table called the Principal Limit Factor Table, and it has, for every age at every possible interest rate, a percentage of value that would be advanced, that would be able to be advanced to that borrower.
Okay, so we don't put in a buffer there. You go.
No, I believe FHA does in that. I mean, the idea is that you're trying to, if I had a blackboard, I maybe could show you easier. But
Well, no, what you're trying to tell me is that they can borrow enough money up to a certain point that they believe as the person ages, they will be able to max out to a certain point. My point is there a fudge factor there that plays in at some point you would go up to this point, but there'd still be some equity left to cover the mortgage holder in case the market goes down or the home deteriorates? Your answer apparently is no, though. Is that correct?
No, I didn't say that.
Congressman, may I contribute here?
Yeah.
I think FHA tries to set the loan limits conservatively enough to allow for the issue that you're discussing, that they are trying to factor in the way people will age, but they are assuming home price appreciation over time, understanding there may be some dips.
Okay, thank you. With regards to disclosures, what kind of disclosures are made? You know, whenever a person takes out a normal home loan, you literally have a package that's this thick. I mean, we had a gentleman here one time who was from the credit union folks, and he actually had a loan packet that was 7 inches tall. He said, Congressman, we no longer measure by the inch, we measure by the pound. What kind of disclosures are involved with regards to a reverse mortgage for the borrower?
There's a pretty big stack of documents that have to be signed at
Same amount
closing.
of documents as
I would
somebody
say it's
taking out?
probably pretty similar to a forward mortgage. I don't know.
Okay, so you have truth in lending and all that sort of stuff, all your
Yes,
disclosure
Congressman,
boxes.
truth in lending applies.
Okay,
Yes.
very good. A while ago, we were talking about the percentage of loans that, well, we had a number of, I think, Mr. Bell, you commented that a couple of different reverse mortgage lenders that got out of the business. And so my question is, what percentage of the loans are made now by non-bank or non-FHA borrowers?
The large majority of the business, the loans are originated by non-banks. I don't know the exact percentage.
Okay, what kind of oversight do we have over those folks? I mean, if it's made by non-banks do they hold those in, or do they still go to FHA with them?
Typically, the loans made are FHA insured, and then they are sold in the secondary market via the Ginnie Mae.
Even by non-bank folks?
There are issuers that have been approved by Ginnie Mae to issue what we call HMBS, HECM mortgage-backed securities, and the large majority of HECMs are now sold in the secondary market in a...
Are there non-bank entities out there that hold them themselves?
There are non-bank entities that issue the HMBS securities, and it is the purchases of those securities that are basically the owners of the loans.
Okay, and my time's expired. Thank you.
Thank you. I recognize myself for 5 minutes. Thank you all so much for being here and your credible advocacy. One of the things I think is really critical is just representing a community where we've seen so much more. I think we're the state that has the lost more black home ownership than any other country. We've seen it's just a shift alone in the city I was born and raised in Detroit, shift from more homeowners to renters and so forth. And I think it's a result of a lot of combination of things that you guys put forward. So I do appreciate you all educating us, but also continue your effort in putting good policy proposals forward. I want to bring a story from my district here because I think it's important to kind of recenter us of what is at stake. Ella Mae Edmondson Purnell is a senior in my district who's on Social Security income. She gets $988 a month. In 1999, she took out a federal loan reverse mortgage with a company called Financial Freedom. She needed repairs to her home. Literally, rain was coming into her bedroom. And with, no qualifications were really necessary. I'm not sure what kind of disclosures, but she had no idea that part of the agreement that she signed was that when she dies, that instead of it going to her family members as inheritance, that they would foreclose on it and take complete ownership of the home. Again, without fully understanding, but she is just devastated. Across the nation, I think our seniors are facing foreclosure after taking out reverse mortgages, as we've been hearing about, either because they fell behind for my district as property taxes or fell to meet the requirements of very complex mortgage loans. Yet HUD lacks detailed data on how many homeowners have actually lost their homes or are facing foreclosure. We have seen like $200,000 homes being foreclosed as small as $500 property taxes, again, in my district. So, Ms. Mancini, can you talk about the kinds of cases that you've seen your organization deals with all the time with, and why it's so crucial that HUD changes its policy to require loss mitigation?
Thank you, Congresswoman. The issues are very serious, as you've pointed out, and I think that the number of older borrowers who are facing foreclosure on a reverse mortgage because of a property charge default have grown to the point where we need critical attention on this issue. I see in my office on a daily basis people that are struggling to get a repayment plan or an extension of the foreclosure deadline for health circumstances, and oftentimes the servicers refuse to offer those options because they're not required to, and they're just worried about being penalized by HUD for not foreclosing fast enough. We also need HUD to make loss mitigation mandatory. We also need them to allow for more flexibility in the different loss mitigation options so that older homeowners are not forced into bankruptcy or the loss of their home.
Thank you. According to Grand Valley State University, Wayne County, which is literally, I'm the only member of Congress, I think, has all of her communities in one county, I believe. It's 12 different communities. We have the highest reverse mortgage foreclosure rates that we've ever seen between 2013 to 2017. Today, Detroit, for instance, has 5 zip codes that are amongst the top 17 zip codes across the country, and this is a majority black city. This is talking about 85% city. So, Ms. Goodman, do you believe that these organizations aggressively market communities like mine, including, impact of like using celebrity endorsers to target minority borrowers?
The answer is we don't know. And let me actually give you a more complete answer. Basically, reverse mortgage borrowers tend to have lower incomes, less than half of those who take advantage of equity extraction vehicles. They tend to have much, much lower credit scores by more than 50 points. They have more debt more than 60 days past due. So basically, these are borrowers who have no other options, and unfortunately, a disproportionate number of Black and Hispanic households are in that category. In addition, Black and Hispanic borrowers tend to have a larger proportion of their net worth in their home, making them more apt to be reverse mortgage borrowers. So home equity plays a much larger role in the net worth of Black and Hispanic households at 64% and 70% respectively than it does for white households. So I haven't seen a study that adequately differentiates the reality that minority borrowers are apt to be disproportionate users, and you target those who are apt to benefit from the program to explicitly targeting minorities for the program. We don't have the data to differentiate.
I would like to get this last question in. How would you, Ms. Goodman, how could you apply disparate impact to better create better policies that would help our seniors?
I think you really need to figure out what's going on here, and better data would help a lot.
Thank you. The gentleman from Ohio, Mr. Gonzalez, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, everybody, for your testimony and attention to this important issue. Reverse mortgages are an important financial product for many of our seniors, many in my district. So I want to make sure the product works well and how it's supposed to work, but also that the liability on the American taxpayer is well understood. Ms. Goodman suggests separating the funds, which makes sense to me, and I think shores up the financial integrity of the system. And I think the better data component could add to the operational side, which I think is very important. So Ms. Goodman, I'll start with you. I understand that HUD does not collect a significant amount of data on this program. That, to me, seems essential to judge its worth. If HUD were to collect more data on the front end, as well as the termination or foreclosure of a reverse mortgage, which do you think would be most useful?
I actually think HUD collects a fair amount of origination data, and I think, I would defer to the GAO on exactly what additional information is needed. What is totally lacking is performance data.
Yep.
They actually used to produce performance data till about 2011 and then abruptly stopped. So nobody can, and the performance data should include exactly what was foreclosed upon, how it was resolved, what the resolution was, how delinquent the property, the tax and insurance was, but actually releasing that performance data, and I don't know what they collect and what they don't collect, but releasing it would be just extremely helpful.
Thank you. And then, Ms. Cackley, in your testimony, you highlighted that the FHA does not analyze data for purposes such as determining which HECM servicers and lenders receive the most complaints, targeting entities for on-site review, or identifying topics that may need additional borrower education. Can you discuss, in your opinion, how FHA could go about better collecting consumer complaints and how the data could be used to improve service?
Certainly. FHA does collect some complaint data, but they don't do very much with it. They don't collect it in a way that allows them to analyze it. So the first thing is to better organize and collect data that is most useful. They also have access to complaint data from the Consumer Financial Protection Bureau, but they don't leverage that data, and that is also information that could be very useful to them.
So better organization and be more thoughtful about how we leverage it. And then with my last question, Ms. Goodman, in July of 2019, you and your co-authors at the Urban Institute published a paper entitled FinTech Innovation in the Home Purchase and Financing Market, in which you made the following argument: FinTech innovation is changing the way households buy and sell homes, obtain and manage mortgage debt, and monetize housing wealth. You go on to argue that housing is also a huge source of untapped wealth for U.S. homeowners. Companies such as EasyKnock, Figure, HomeTap, and Patch Homes have made it easier to cash out home equity to help households smooth their consumption. Figure and Irene offer a reverse mortgage alternative where borrowers can sell the home, receive cash proceeds, and stay in the home as renters. These recent FinTech innovations offer great potential options to seniors looking for options above and beyond HUD's HECM program, but they are nascent developments in a market dominated by the government-insured product. What has so far held back the development of a private technology-based reverse mortgage market, and what more can be done by HUD and policymakers to encourage more innovation, development, and private sector competition?
The products that we talked about are fairly niche products. Like you can rent your home until you can basically sell your home now and you can live there for the rest of your life. But they're fairly niche products that don't have a lot of traction. One thing that is gaining a fair amount of traction is private reverse mortgage products. Although they are very, very, very small, certainly lowering the loan limits from the current level of lowering the loan limits from the current level of $726,525 nationwide would make a big difference in terms of the development of the proprietary reverse mortgage products, which are actually filling a unique niche right now. I mean, right now, for example, condos are almost entirely proprietary products. The issues are, first, the loan limits of the HECM program are very, very high, and secondly, some state laws actually prohibit or make it very difficult for proprietary reverse mortgage products. I think if the loan limits were reduced, the states would be forced to revise their laws.
Gotcha. Well, thank you very much for your time, and I yield back.
The gentleman from Missouri, Mr. Cleaver, who is also the chair for the Subcommittee on National Security, International Development, and Monetary Policy, is recognized for 5 minutes.
Thank you, Madam Chair. I really think this is an important hearing. I think there are probably 9 of us on this committee who were here on the day that we were informed by Ben Bernanke, the Secretary of the Treasury, the head of the FDIC, Sheila Bair, and it was one of the most awful days of my political career, and I'm always paranoid about what could happen afterward. And one of the fears is of course what we've been talking about, and that is what happened to minorities. We had individuals who publicly, right here in this committee, said that there was great intentionality in targeting brown and black individuals to victimize. And these were people in the lending community who acknowledged it, what happened with a lot of these exotic products, and telling people you could buy a $100,000 house even if you were working for the yellow bus company, making $15,000 a year. And that's a real example. So, you know, here we are today where we're, you know, trying to figure out how to handle the reverse mortgages and what's happening also, again, in predominantly minority communities that have been targeted. And USA Today says foreclosures of reverse mortgages disproportionately impact these minority communities. You know, what is it that is being done that would allow this targeting to occur? Can any of you respond, please?
Congressman, I think that the USA Today article you referred to does suggest that there may have been some deliberate targeting of communities of color, but I think another factor that we believe is at play is that the history of disinvestment from those communities, lack of access to good mortgage credit, followed by targeting for abusive subprime mortgages that you referred to earlier, then made those communities more likely to need reverse mortgages. A lot of older homeowners refinance into a reverse mortgage to get out of trouble on a bad subprime loan. So we believe that that's one of the factors that has led to the large number of reverse mortgages in communities of color, because of the abusive subprime practices that were targeted.
You know, one of the things I will be eternally angry about, my youngest son saw the movie about what happened, I forgot the name of the movie, the collapse, and they had all of us in the movie, you know, and my son went to see the movie. He came out and he said, "I hate all of you." And he said, you know, what's going to happen? And I had to look him in the eye and say, nothing. Because as of today, nobody has been prosecuted. Now you steal some potato chips out of 7-Eleven, you go to jail. You steal $20 billion from the public and send people into the poorhouse, and you go to Bermuda, play golf. I'm telling you those things you already know, but what can we do to prevent this from continuing? I mean, in minority communities, the house is the most valuable product you have. I mean, no savings. This is it. This is my wealth built into this house. What can we do to stop this? Make sure it doesn't happen again.
So let me take the first stab at it, if you don't mind, and that is, you know, right now we do a financial assessment of the borrower, and if the borrower can't afford tax and insurance payments, which is one reason for default, then there's a tax and insurance set aside. I would actually not have a financial assessment, and I would make that the default. There is a tax and insurance set aside unless you opt for a financial assessment and you pass, in which case you can choose not to have that set aside. But what that would do is make sure that the tax and insurance payments are escrowed and taken care of.
Ms. Cackley.
I would just add that is a solution going forward, but right now you have a lot of reverse mortgages that are in effect, and so FHA needs to have oversight of this program. They need to have oversight of the servicers. They need to be making sure that the servicers are offering the kinds of repayment plans and extensions that are available in the the way the program is designed, but they're not necessarily making it to the people who can benefit from them, and that's something that FHA can do.
Thank you, Madam Chair.
Thank you. I'd like to thank all of our witnesses for their testimony today. Without objection, all the members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask all of our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit materials to the chair for inclusion into the record. The hearing is adjourned.